Thank you, Emma. Hi, I'm Aisling Nicholson, tax partner based in Belfast. As just mentioned, this is the corporate tax session specific to Northern Ireland, and I'm here to give you a run through of some of the key tax changes in UK tax this year. If you would like to listen to both the Northern Ireland and Republic of Ireland briefings, recordings will be available on our DFRP webpage following the conference. In terms of UK tax, as you are no doubt aware, we've had two budgets this year, March and October, as well as a tax day in March, which saw the release of draft legislation, new consultation documents and responses to prior consultations, and we're expecting a further tax day in autumn. We've also seen some significant announcements outside of the budget, for example, the Health and Social Care Levy announced in September. It is important to acknowledge that the wider international tax reform from OECD's work continues to have an impact in the UK, and we'll probably see more in this in the upcoming year. But given the time constraints today, we will concentrate on specific UK changes, including the increase in the UK corporate tax rate, changes linked to investment and innovation incentives, other key measures from the budgets, and changes coming in next year and consultations and reviews to watch out for. One of the most significant changes in the March budget was the announcement, with effect from the 1st of April 2023, of a new main rate of UK corporation tax of 25%, up from the current 19%. This will apply where taxable profits are in excess of £250,000. Where a company has £50,000 of taxable profits or less, it will maintain a 19% tax rate, known as the small profits rate. For companies with taxable profits of £50,001 up to £250,000, they will pay at the main rate of tax, being 25%, less a marginal relief deduction, which tapers the effective corporate tax rate from the 19% up to the 25%. So a similar approach to UK corporate tax calculations that was undertaken prior to April 2015. The upper and lower limits of £250,000 and £50,000 are adjusted for accounting periods of less than 12 months, and also for the number of associated companies in the worldwide group, that is more than just the UK group companies. Certain businesses or activities in the UK, for example, UK branches of non-resident entities or close investment holding companies, will always pay at the main rate of 25%. And finally, the autumn budget announced that the bank surcharge will be cut from 8% to 3% to maintain the banking sector's competitiveness. This is still an overall increase from the 27% that the banks pay today to 28% from April 2023 when it takes effect. One immediate impact of these changes is from a reporting perspective. The main tax rate changes were enacted in June 21, aside from the bank surcharge, so they have a measurement impact for financial statement balance sheet dates which follow that. Companies need to account for their deferred tax assets and liabilities at the tax rate expected to apply when the asset is released or the liability is settled. And this could lead to significant deferred tax movements where large balances are held on the balance sheet. In terms of investment and innovation incentives, there are two key areas covered here today, and we'll start with capital expenditure and move on to R&D incentives in a moment. The first announcement back in March was the introduction of two temporary enhancements to the capital allowances regime, which are effectively the UK's tax depreciation rules. And it's relevant for capital expenditure incurred between the 1st of April 2021 and 31st of March 2023. The first announcement was the introduction of a super deduction in the form of a 130% first-year allowance for expenditure on qualifying plant and machinery that it would otherwise fall in the main pool, where it would have received an 18% writing down allowance. The second was for a 50% first-year allowance for items that would otherwise fall within the special rate assets pool, with 6% writing down allowances. These enhanced allowances must be claimed, and they don't apply to all plant and machinery expenditure. You need to be buying new assets, they need to be acquired by a company, and it can exclude assets such as cars. The contract for the acquisition of the assets must be after the budget date of 3rd of March 2021, and there is a need to track these assets where claims are made, as if they are disposed of within the same 2-year period, there are special rules pertaining to the disposal. This can give rise to some complicated adjustments rather than just a simple amendment to the existing pool. So these claims can be more administratively complex. As such, it was welcome to see an extension of the annual investment allowance in the recent budget, which is a group-wide £1 million first-year allowance on plant and machinery. That had been due to fall to £200,000 at the end of this calendar year, but is now extended to 31st of March 2023, in line with the other provisions. The key message to take away is that it is not enough to simply consider the headline relief rate when deciding which claims to make. It's possible that greater benefits could be achieved by a more holistic assessment of the expenditure in the context of the wider profile of spend, the loss profile of the company, and the other tax attribution options for relief that it may have. The second area where we've seen and will continue to see change is in respect of the UK's research and development incentive regimes. There are currently two, one for SMEs and the RDEC, the Research and Development Expenditure Credit Regime, which is for larger companies, although sometimes used by SMEs also. We'd already seen the RDEC rate increase from 12% to 13% back in April 2020. However, the increase in the main rate of corporation tax to 25% will see the net benefits from these regimes vary depending on which scheme is relevant and what the rate of tax is that the company pays. So, for example, an SME paying tax at the main rate of 25% from April 23 may see an increase in the benefit of the SMA scheme up to 32.5%. However, the loss-making companies, which can claim a cash credit, need to be conscious of the new SME payable tax credit cap, which can limit the cash credit to £20,000 plus 3 times their national insurance and PAYE bill. So potentially an issue for SMEs, which, for example, subcontract substantial levels of R&D activity. For RDEC, the overall benefit could decrease due to the impact of the increasing corporation tax rate on the taxable above-the-line credit, which forms part of that regime. The negative impact of this may be offset somewhat by the announcement in the recent autumn budget, which will allow data and cloud computing costs to qualify as expenditure for R&D. So this will be good for the tech sector and other sectors which have similar costs, so health and life sciences, for example. The flip side of this was an announcement that there are likely to be changes to focus the regime on activity which takes place in the UK, which could be an issue for some taxpayers. Both of these changes will be implemented from April 2023. HMRC have also said they will concentrate on identifying what they see as being fraudulent claims and improving compliance. But a wider review of the operation of the rules is still in hand. Further reform is anticipated, but the overall message is positive, in that HMRC sees these reliefs and incentives as key in driving UK economic growth and job creation. There are a couple of other key measures that it makes sense to touch on briefly here. For companies that have made or are making losses as a result of difficult trading conditions and which have been cash tax paying previously, there's a temporary extended loss carryback window from 1 year to 3 years for accounting periods ending in the years to 31 March 2021 and to 31 March 2022. The loss carryback is limited to £2 million of loss arising in each of those years on a group basis. And some companies are weighing up whether they should carry back the losses to free up some cash today versus carry forward the losses to use when tax rates will be higher. And this should form part of that wider holistic review taking account of reliefs and incentives and tax attributes that we mentioned earlier. September saw the announcement of a new health and social care levy to fund the NHS and social care in the UK. This will see an increase in the tax burden on employers, employees and recipients of dividend income of 1.25% starting on the 1st of April 2022. The employer and employee costs will be administered initially through an adjustment to national insurance rates, and thereafter they will be accounted for in a similar way to national insurance, but as a separately administered and reported levy. So this is a significant additional burden for all taxpayers. And finally, there's a long list of other areas identified where new legislation will come into place in the upcoming year, or where there are areas identified for reform and consultation. Just calling out one or two which may be of further interest. The notification of uncertain tax positions, which is legislation coming in April of next year, will see large companies having to report provisions for tax uncertainty to HMRC in a more live basis than in just their tax returns. And this will apply for corporation tax, income tax, which includes PAYE and VAT. There are some thresholds which will apply, and you have to use these rules where you have taken a position that is at odds with what HMRC are known to think about a particular rule in the tax legislation. The plastics packaging tax, also coming in April 2022, is relevant for importers of plastics packaging components into the UK, as well as manufacturers of plastic packaging. And it's having a wide practical impact, due in part to the need to keep specific records, and also it's having an impact on wider supply chain conversations, which could be significant for many companies. It's likely we will see more in the sustainability space following on from COP26 commitments this month. There's a new residential property developer tax of 4%, applying where construction companies have taxable profits in excess of 25 million, and we await further details of this. And as you can see, there are consultations for potential reform across a series of other areas as shown. The landscape for UK tax for those potentially impacted will continue to change for some time. Thank you for your time. I now ask you to return to the main stage where Donal will be taking us through data protection.